India spread betting. Trading derivatives with ease.
Sovereign CDS spreads explained, brought to you by India Spread Betting. Many of us wonder, what is sovereign CDS spread? A sovereign credit default swap (CDS) spread is a financial instrument that measures the cost of insuring against the default of a government's debt. In other words, it is a type of insurance policy against a government defaulting on its obligations, such as not being able to pay back its debts. The sovereign CDS spread is quoted in basis points, BPS, which is a unit of measure commonly used in finance. 1 basis point is equal to 0.01% or 1/100th of a percent. For example, a spread of 100 BPS means that the cost of insuring against a government default is 1% per year. The sovereign CDS spread reflects the perceived credit risk of a government. A higher spread indicates that the market perceives a higher risk of default by the government, while a lower spread indicates that the market perceives a lower risk of default. Investors, such as hedge funds and institutional investors, use sovereign CDS spreads to hedge their exposure to government debt and to speculate on changes in the creditworthiness of a government. Sovereign CDS spreads are also used by rating agencies to assess the creditworthiness of governments and to assign credit ratings. How will current rise in sovereign CDS spreads in USA affect global stock markets? The rise in the one-year sovereign CDS spreads in the USA could potentially have an impact on global stock markets, although the extent of this impact would depend on various factors. Firstly, the rise in the sovereign CDS spread indicates an increase in perceived credit risk of the US government, which could lead to a decrease in investor confidence and an increase in risk aversion. This could lead to a shift of funds out of equities and into safer assets such as bonds, which could potentially decrease global stock markets. However, other factors could offset this effect. For example, a rise in the sovereign CDS spread could be caused by an increase in inflation expectations, which could lead to an increase in corporate profits and support stock prices. Additionally, the U.S. stock market is only one of many factors that influence global stock markets, and other factors such as economic growth, geopolitical events, and monetary policy could have a greater impact on market performance. Overall, it is difficult to predict with certainty how the rise in the one-year sovereign CDS spread in the USA will affect global stock markets, and the impact will depend on a variety of factors that can be difficult to anticipate. What is the difference between bond yields and sovereign CDS spreads? Bond yields and sovereign CDS spreads are both measures of credit risk and are used by investors to assess the creditworthiness of a government or a corporation. However, they represent different aspects of credit risk. Bond yields represent the interest rate paid by a government or a corporation to borrow money by issuing bonds. The bond yield reflects the return that investors demand for holding the bond, and it is influenced by various factors such as inflation expectations, economic growth, and the creditworthiness of the issuer. Generally, higher credit risk leads to higher bond yields as investors demand a higher return to compensate for the increased risk. Sovereign CDS spreads, on the other hand, are a measure of the cost of insuring against the default of a government's debt. It reflects the perceived credit risk of the government and the cost of buying insurance against a potential default. A higher sovereign CDS spread indicates that the market perceives a higher risk of default by the government and a higher cost of buying insurance. In essence, while bond yields represent the cost of borrowing for the government or corporation, the sovereign CDS spread represents the cost of insuring against the default of the government's debt. Investors use both measures to assess the creditworthiness of a government or corporation, and they may use them in different ways. For example, bond yields may be used to estimate the cost of borrowing for a corporation, while sovereign CDS spreads may be used by investors to hedge their exposure to government debt or speculate on changes in creditworthiness.
Why are bond yields rallying worldwide? Does that reflect world will witness recession by the end of this year? We will cover this in our upcoming video. Stay tuned for more updates on microeconomic factors. Please be sure to like, share and subscribe to the channel and hit the bell icon to receive more such informational videos and daily market updates for trading index derivatives, especially options. See you in the next video. Thank you.